Hello investors and traders, today we'll speak about 3 dividend stocks to buy right now. This month could be even tougher, but we are in the midst of the bear market with the rising interest rates. However, I believe investors can survive these challenging months by sticking with the high yielding blue chip tech stocks. And before we start, don't forget to subscribe into my channel if you like dividend stocks, US stock analysis. In my channel I have many videos relating American stocks, Canadian stocks, so don't forget to subscribe into my channel. And let's start for the first stock for today. It's AT&T. Today AT&T is a more streamlined telecom company focused on expanding its core 5G and the fiber networks. AT&T now expects its wireless service revenue, which accounted for more than half of its top line last quarter, to rise but as much as 5% this year. It expects its total revenue to grow by the low single digits and for its adjusted EPS to increase about 2%. The company reduced its dividend after spinning off Warner Bros. Discovery, but it still pays a hefty forward dividend yield of 6%. It notably reduced its all-for-year free cash flow guidance from 16 billions to 14 billions last quarter due to issues with delayed customer payment, higher investment and lower business wireline margins, but it can still easily cover its planned dividend payment of about 8 billions this year. And let's look at the chart of this company. It's a monthly chart, of course. We can see that now we are trading at a declining channel, but here in my mind there is a major support level. It's now 16 bucks, and now also check that now we are trading at the levels of 2022. So here we are close to the lower border of this channel, and also here we have of course the major support level for last 20 years. And look at the side, the momentum indicator. It's also we can see that this stock is already oversold. It weekly RSI 34. So in my mind, from here there is a probability to see bounce for this stock. Also we can see a huge cluster of horizontal volumes here. It's level of 22. So from these levels and from this point I see there is a probability to see a nice bounce in this stock. And let's have a look on its fundamental parameters. We can see that debt to EBITDA ratio is 2.7, gross margin is 54%, net income is 30%, quite good marginality. The PE ratio, the value of this stock is very cheap. We can see that PE ratio only 6 and the PS ratio, price per share, less than 1. So it's telling us that now already this stock is very cheap now. And of course the dividends, yeah, we can see that the forward dividend yield is 6.6%. The 3-year dividend growth rate is more than 1, and the dividend payout is less than 1. So in my mind there is a possibility this company can even have a potential to increase its dividend payments. So generally speaking, AT&T might lack any near-term catalyst, but its stock trades at just 7 times forward earning. That low valuation and high yield should limit its downside potential and make it a reliable, safe, even stock for these months. And let's move forward to the second stock. Today it's Cisco. So Cisco partly offset this year slowdown with the growth of its cybersecurity services, enterprise software, and it's expected thus storm cloud clear throughout fiscal 2022. It claims its hardware sales have been held back by supply constraints instead of demand constraints, and it expects its growth to accelerate once the supply chain headwinds weaken again. For the next year, Cisco expected revenue and adjusted EPS to both rise by 5%. That acceleration would put it back on track to achieve its long-term goal, which it introduced during its Investor Day presentation last September, of growing its annual revenue at a compound annual rate (CAGR) of 5% in the years of 2021 and 2025. Let's have a look on this chart. In my mind, here we had impulse. It was 5 wave. The first one, second, third, the fourth one, and the 5. Then the impulse finished, and now it's clean ABC move. In my mind, it was the A wave, then small bounce here B, and here I think that now there is already developing the wave C, and from this point we have a probability to see the stock a little bit lower. But now here already its dividend yield is more than 3%, and its performance year to date is more than 30%. So I don't see a huge potential for a slowdown. That's why, of course, now I'm beginning to buy this stock. So let's have a look on fundamentals of Cisco. We can see total score is very high, it's 93. Its financial stability is quite high, it's very nice. You can see that the EBITDA ratio is less than 1, very high interest coverage. Any problems with that? In my mind, the cash ratio is 2, so this company has twice cash on the balance sheet, more than that. So any problems with that? The marginality also very impressive, very high. Gross is 72, net margin is 22. So very nice marginality. Also we can see that the P ratio 15, it's not expensive, and the PS ratio for such marginality, PS ratio is about 3, so also it's very nice. And we can see that in the future analysts expecting growth of its EPS and revenue for the future years. And related to dividend, current dividend yield is 3.5%. Its payout ratio is also high, so half of it net income company pays as dividend. It's very nice, and the 3-year dividend growth rate is also more than 3%. So it's now it became a very nice and very attractive dividend stock. Also, Cisco raised its payout annually for over a decade. Cisco might not generate any massive near-term gains, but it's a safe place to park your cash to generate some extra income. And the last stock for today, it's HP. HP's stock lost more than a quarter of its value this year as investor fretted over its slowing sales of consumer PCs in a post-lockdown market. However, that sell-off reduced HP's forward multiple to 7, while boosting its forward yield to 3.6%. HP's PC and printing revenues both declined year over year last quarter, and analysts expect that slowdown to persist through the next year, which will start at the end of October. But as HP sales growth stalls out, it remains committed to reining its operating expenses, returning more than 100 of its annual free cash flow to its investors through buybacks and dividends, and diversifying its business with fresh investment. That is why HP recently acquired Poly, a producer of audio and video conferencing products, for $3 billion to upgrade its PCs for remote and hybrid workers. And let's check its chart of HP. It's a weekly chart, so in my mind from 2020, last 10 years. We are trading in a rising channel. Here in my mind it is an impulse, so the first wave, the second, and the third correction in the fourth, and here I'm not sure that the fifth wave we finished here, because maybe from this level we can see another move up. So I'm not sure it finished. Maybe from here we can see a nice bounce. So I can't tell that here this fifth wave, usually fifth wave is the last wave of the impulse. So most probably you can see another move here. It can be something like that, because you can see here the RSI momentum is already oversold, so it's 34. So from here I'm expecting a nice bounce to the here to the upper border of this rising channel. And let's have a quick look at for fundamentals. It's very strong for HP. We can see that the debt to EBITDA ratio is only 1.5. Interest coverage very impressive, 20. So any problems with that for the company? The marginality not so high, but net margin is about 10%. It's quite good and very cheap. We can see that the PE ratio is only less than 5, and the PS ratio is even lower than 1. So for here for 46 cents you can buy $1 of revenue for this stock. So it's very cheap. And the dividend, yeah, it's now about 4%. The payout ratio is very small. So there is a huge amount, a huge potential for this company to even increase its dividend payments. And the last 3 years dividend growth rate is more than 11%. Also, it's double digit. It's very impressive figures. So it was 3 best dividend stocks that I'm continue to buy right now. The dividend yield for me is quite enough. Very interesting for me. It's tech stocks. So why not? It's the value of the stock, the valuation, the ratios is not expensive. So for me all these 3 stocks is very attractive. So if you like this video, press the like button, and don't forget to subscribe into my channel, because in the future I will have a lot of interesting video related to dividend stocks, to high dividend stocks, American stocks, Canadian stocks, about the stock market, technical analysis, Elliott wave analysis. So don't forget to subscribe, and see you the next time. Bye.